Welcome, ladies and gentlemen, from me, Guy Monson, to our regular 6-minute strategy summary. Ever since the great financial crisis of 2008-9, policymakers have had two unstated goals. The first is to normalise interest rates, and the second is to stop using public funds to subsidise private risk-taking. It's possible that both these goals will be achieved, at least in part, in 2022. First of all, a series of interest rate rises across the Western world will play out over the next 12 to 18 months. Secondly, the giant QE programmes that have inflated central bank balance sheets will be put in reverse. Quantitative easing, if you like, becoming quantitative tightening. Thirdly and finally, the giant fiscal programmes that supported us through the COVID years will gradually be dialed back and will begin to rebuild public finances. What does this mean for financial markets? Well, it's a radical change in the backdrop. After all, we've had interest rates in the UK below 1% here for the last 13 years. In Europe, they've had negative interest rates for more than 7 years. This has big implications for portfolios, particularly as we're making this change against a strongly inflationary backdrop, and also one where the Ukrainian crisis is causing energy prices to be higher for longer. We'll look at what this means for your portfolio, what it means for our asset allocation, and our response in the slides ahead. So let's begin with our familiar first slide, showing the progress of global GDP since the beginning of the COVID crisis. Our Q4 data is now all in, so we can see that really every region in the world, with the exception of the UK, is at or larger than its pre-COVID levels, and the UK is very close to it. That is an extraordinary achievement when you consider the drawdowns that were evident just 6 or 12 months ago. On the right-hand panel, you can see the price we've paid for that in terms of inflation. US inflation at 7.5%, the UK number in this week at 5.5% and rising. So let's look what this means for future inflation rates and the sort of policy response we can expect from central banks. Well, we're thinking that US inflation will average somewhere around 4.5 to 5% in 2022, falling down to 2.7 to 3% in 2023 and beyond. If you look on the right-hand panel, you can see that graphically, and you can see that looks somewhat like the sort of levels that we saw back in the early 2000s. Very different, though, from the 1.8% sub-target rates that we saw after the great financial crisis, and really for the last 12 or 13 years. How will monetary policy respond? Well, first of all, of course, QE will be dialed back. $2.9 trillion of government bonds bought in 2021, falling to $470 billion this year. And in 2023, we expect QE to shift into QT, with central bank balance sheets actually shrinking by $1.1 trillion, very large numbers. Interest rate rises, probably 5 in the US this year, and 2 to 3 here in the UK. So what does this look like graphically? On the left-hand panel, I've shown that progression upwards of interest rates that we expect in the US over the next 2 to 3 years. A much steeper move than we saw back in 2015 to 18, accentuating really the urgency of the programme today against this inflationary backdrop. On the right-hand panel, you can see those same moves for central bank balance sheets, and you can see us rolling over from a peak of just below $9 trillion on the Federal Reserve balance sheet down to somewhere around $7 trillion in 2024-5. So the twin effects of rising interest rates and shrinking central bank balance sheets are going to have a material impact on asset prices. What is that? Well, first of all, look at bond markets. We've seen this chart before, US core CPI on the x-axis, 10-year bond yields on the y-axis, with those dots, the statistics back to 1990. And you can see out there on the right where we are today, that 2022, January 2022, we got 6% core inflation rates, but just 2% bond yields. If that was to normalise, there is a huge gap to the upside. And so there is the possibility that the sell-off in bond yields is both quicker and more aggressive than people expect. Secondly, of course, there's going to be an effect on market valuations. Very low interest rates, very low bond yields push up the valuation of long duration assets. I've shown there on the left-hand side the PE multiple of various sectors of the MSCI World Index, business services, global technology, and the main index itself there in blue. And you can see already those PE multiples beginning to roll over and compress, but still well above their levels of the pre-COVID period. So there's risks too to some of these growth stocks and more speculative assets. On the right-hand side, I've shown profit margins, which are already at record levels. So while EPS and earnings could offset some of that effect, it's going to be a big headwind in terms of valuation. Thirdly and finally, we're doing this at a time of potential conflict in Ukraine, and it's a conflict that could run for longer than many expect. Why do we think this? Well, in the left-hand panel, I've shown NATO's expanding membership, and particularly the 15 new countries that have joined since the end of the post-Cold War. And it's very evident how that has compressed Russian spheres of influence. So this is a long-term goal of Mr. Putin to reverse, and it could mean this crisis goes on for longer than many expect, and that will mean, of course, higher energy prices, gas and oil, for longer. And that, of course, will complicate monetary policy. So how are we responding? Well, first of all, we're continuing with our strong underweight to bonds. We see just too much risk of higher yields. Secondly, following our meeting in January, we've pulled back our equity overweight to neutral, reflecting our concerns over potential equity valuations. Thirdly, we've added to alternatives, keeping them at a strong overweight, particularly gold, renewables and infrastructure. And fourthly, we have a precautionary position in cash. Well, I hope that's clear. I hope it throws up some of the issues that we're going to be wrestling with in 2022 and gives you an idea of how our policy will develop. Thank you.